The Canadian stock market has finally done it. After months of anticipation and speculation, the Toronto Stock Exchange has reached a milestone that many investors and analysts have been watching for with bated breath. This achievement marks a significant moment in the country's financial history, capturing the attention of not just Canadians, but the global investment community as well. After a year of steady climbing, the S&P/TSX Composite Index surged past its previous peak, reaching a record 24,257.29 on October 10, 2024. This new high didn't happen overnight. It was the result of persistent growth, renewed investor confidence, and a series of positive economic signals that encouraged both domestic and international buyers to pour money into Canadian equities. This wasn't just another good day on Bay Street. It was a testament to the resilience of Canada's economic engines. The mood was electric, with traders and business leaders alike celebrating a hard-fought victory after a period of uncertainty and volatility. The achievement reflects not only the strength of the market, but also the determination of Canadian businesses to adapt and thrive in a rapidly changing world. For investors, this milestone is both validation and a prompt to consider what comes next. Many are now reassessing their strategies, weighing the potential for further gains against the risks that inevitably come with new highs. Some see this as a green light to increase their exposure, while others are taking a more cautious approach, mindful of the lessons learned from past market cycles. The TSX's new high signals a powerful recovery, reflecting the strength of Canada's core industries despite global uncertainty. From energy and natural resources to banking and technology, each sector has played a crucial role in driving the market forward. This broad-based growth suggests that the Canadian economy is not just rebounding, but evolving to meet the challenges of a new era. But is this the peak, or just the beginning of a new ascent? The market's future remains uncertain, with many variables still in play. Investors and analysts alike are watching closely, looking for signs that could indicate whether this rally has more room to run, or if a correction is on the horizon. To answer that, we need to understand the forces that push the TSX to this record. It's not just about numbers on a screen, it's about the underlying trends, the policy decisions, and the global events that have shaped investor sentiment and market performance. By examining booming commodities, shifting interest rate expectations, and the rapid growth of the tech sector, we can better prepare for what lies ahead. Understanding these drivers will help investors and businesses alike navigate the opportunities and challenges that come with a market at all-time highs. To truly appreciate this remarkable achievement, it's important to dig deeper into the numbers and understand what's driving the Toronto Stock Exchange's latest milestone. The TSX has long been a barometer of Canada's economic health, and this recent surge is no exception. Let's look beyond the headline number and explore the forces at play beneath the surface. While the record-breaking figure grabs attention, the real story lies in the details of sector performance and market dynamics. The TSX's climb in 2024 was broad-based, with gains seen across multiple sectors. Often it managed to keep pace with or even outshine the S&P 500, a feat that highlights the strength and resilience of Canada's unique economic landscape. Unlike markets driven by a handful of tech giants, the TSX's growth is rooted in a diverse set of industries. Energy and materials led the charge, each gaining over 1% on the record-breaking day, thanks to a sustained commodities boom. These sectors have benefited from global demand for resources, and their performance has been a major catalyst for the TSX's upward momentum. However, not all sectors soared. Financials dipped due to troubling news from a major bank, which sent ripples of concern through the market. This serves as a reminder that even in times of overall growth, challenges and risks remain. Healthcare also lagged behind, weighed down by sector-specific headwinds. This underperformance highlights the importance of diversification, as not every part of the market moves in sync. Compared to the S&P 500's rapid, sometimes volatile run, the TSX's ascent has been more measured and grounded in tangible assets. This steady growth reflects a market built on real-world value rather than speculative trends. The Canadian story is less about speculative tech fervor and more about the rising value of oil, gas, gold, and copper. These commodities are the backbone of the nation's economy, and their strength has provided a solid foundation for investors. This foundation offers a different, perhaps more stable investment thesis, one that appeals to those seeking long-term growth and resilience in a changing global market. As the TSX continues to evolve, its numbers tell a story of both opportunity and caution, reminding us that every milestone is built on a complex web of factors. At the heart of the TSX's surge is a simple story: the world wants what Canada has. The 2024 commodities boom, soaring oil, gas, and gold prices, directly boosted Canadian producers and the broader market. Companies like Suncor Energy and Barrick Gold saw profits rise with global demand, creating a wave of positive momentum. A weaker Canadian dollar further amplified export competitiveness and profit margins for resource companies. This classic Canadian advantage powers the market, but also ties its fate to volatile global cycles. While the engine is running hot now, investors must remember that global demand can shift quickly. Wise investors know this boom won't last forever. Beyond commodities, another force is at play: hopes for lower interest rates. Signals from central banks have fueled optimism, with markets betting on imminent rate cuts after a period of aggressive hikes. When rates are expected to fall, stocks become more attractive than bonds, prompting a broad rally. In October, U.S. markets priced in a 93% chance of a Fed rate cut, and Canadian investors followed suit. But this rally is built on expectations, not reality. Rate cuts haven't happened yet. If economic data disappoints, sentiment could reverse quickly. Investors are betting the inflation fight is over, but the outcome is far from certain. For now, the bet is paying off, but caution is warranted.
While commodities and rate cut hopes dominate headlines, there's a quieter story unfolding beneath the surface, one that's steadily transforming Canada's economic landscape. For decades, the country's financial news has been driven by oil prices, mining booms, and the ups and downs of the resource sector. But now, a new force is emerging, and it's changing the narrative in subtle but significant ways. Canada's tech sector is quietly gaining strength, fueled by a new generation of entrepreneurs, engineers, and visionaries who are building companies that compete on the global stage. These innovators are creating products and services that reach far beyond Canada's borders, attracting international attention and investment. For years, the TSX lagged in tech, overshadowed by the dominance of energy and financial stocks. Investors often overlooked Canadian tech, seeing it as a minor player compared to Silicon Valley giants. But that's changing as innovative Canadian firms gain global traction. Shopify leads the way, having become a household name and a symbol of what's possible for Canadian technology. Its rapid growth and international success have inspired a wave of startups and scale-ups across the country. Shopify's success is boosting the entire sector, raising the profile of Canadian tech and encouraging more investors to take notice. Its achievements have paved the way for other companies to follow, creating a ripple effect throughout the industry. Investors are now analyzing tech company reports with renewed interest, searching for the next breakout star. Financial analysts are dedicating more resources to tracking tech sector stocks, and venture capital is flowing into Canadian startups at record levels. The momentum from US tech and AI enthusiasm is spilling over, benefiting Canadian SaaS, fintech, and digital infrastructure firms. These companies are leveraging artificial intelligence, cloud computing, and digital payments to carve out their own niches in the global market. This new tech ecosystem adds dynamism and diversification to the TSX, making the market more resilient and less dependent on the traditional boom and bust cycles of commodities. By balancing the cyclical resource sectors with innovative technology companies, the TSX is evolving into a more balanced and forward-looking index. The rise of tech is reshaping the TSX, bringing new energy and optimism to Canadian markets. The trading floor is no longer just about oil and gas, it's about software, data, and digital transformation. This shift is making the TSX more modern and resilient. For long-term investors, it means new opportunities and a chance to participate in the growth of world-class technology companies. A strong tech sector offers an alternative growth engine if commodities cool, providing stability and potential for higher returns, even when traditional sectors face headwinds. Canada's market is no longer just about resources. Today, it's a blend of tradition and innovation, with technology playing a starring role in the country's economic future. As the tech revolution continues, Canada's market is evolving for the future, promising a new era of growth, resilience, and global relevance.
Celebrating a record high is great, but it's also a time for vigilance.
The biggest risk is valuation. After rapid gains, is the market overheated? History shows that sharp rallies can be followed by corrections as prices realign with fundamentals.
External threats loom, especially from the US and China. A slowdown in either could hit Canadian exports and commodity prices hard. Closer to home, TD Bank's troubles and potential US penalties cast a shadow over the financial sector.
Investor sentiment is another risk. If enough people get nervous and sell, a correction can feed on itself.
Navigating ahead means balancing optimism with awareness of these real dangers. The forces driving the TSX up can just as easily pull it back down. Stay alert and don't get complacent.
In a record-setting market, it's easy to ignore warning signs. Here's a checklist to stay disciplined.
First, watch for sharp reversals in commodity prices. Energy and materials drive the TSX, so a downturn is a major red flag.
Second, monitor central bank signals. If rate cut expectations fade, markets could react negatively. Pay close attention to their statements and press conferences. Third, watch the financial sector, especially developments with TD Bank. Trouble here can spread fear across the market.
A weakening financial sector is a serious warning reflecting broader economic health.
Finally, keep an eye on valuations and investor sentiment. Extreme bullishness often precedes corrections. If you see stretched valuations and excessive greed, it's time to reassess your risk.
Even in a record market, it's not time to exit. It's time to be selective.
Look for sectors with durable long-term growth drivers.
Renewable energy is a top theme, with Canadian firms in solar, wind, and green infrastructure poised for growth.
The AI revolution also needs physical infrastructure, data centers, semiconductors, and cooling systems, where Canadian companies can thrive.
Within materials, focus on copper and gold miners. Copper is vital for green tech, and gold remains a safe haven.
These sectors offer a balance of growth and stability, helping investors weather market swings. Build a resilient portfolio by targeting these long-term trends. With the TSX at a record, what should investors do? Trying to time the market rarely works. Dollar-cost averaging, investing a fixed amount at regular intervals, removes emotion and builds wealth over time. When markets are high, you buy fewer shares. When they dip, you buy more, smoothing out your average cost. This strategy is especially valuable after a market high, helping you avoid paralysis and stay invested. It's a humble, consistent approach that enforces the most important habit: discipline. The TSX's record was driven by commodities, rate cut hopes, and tech growth, but risks remain. By focusing on promising sectors and using dollar-cost averaging, you can turn today's headlines into tomorrow's financial success.